treasuries are just debt from another indebted economy. And so it's hard to believe that's going to be used to improve the quality of their reserves and give more credibility to their fiat currencies. And so that's why I believe gold is ultimately the ultimate form of money that will prevail in this environment going forward too.
Maneco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Tavi Costa. He's a portfolio manager at Crescat Capital. We spoke last about 3.5 months ago in April. Things have changed a lot in the commodities and precious metals space. And I say changed in the short term. That's my opinion. First, though, Tavi, welcome and thank you for coming on the channel.
Well, it's my pleasure to be here again. Looking forward to speaking with you.
Thank you. And I want to kick off with the U.S. economy and I guess also the Western economy, European economy. There's a lot of debate now of about what a recession really is. And I just saw that the Atlanta Fed now GDP, their forecast for the third quarter already, they've lowered it from 2.1 to 1.3. But of course, according to Wall Street, to the administration, to Paul Krugman, he actually said it doesn't really matter if it's a recession, the economy is doing well. What's your take on all this?
Well, I think the biggest argument that the economy is doing well is related to employment, when actually employment and most of labor market indicators are all lagging indicators. And so I caution a lot of people to be looking at that to make an assumption that the economy is doing well. We're also seeing changes on the margin already. If you look at jobless claims, initial jobless claims have been rising since March. Continuing jobless claims have been rising as well. We've seen the increase of part-time jobs. So all those should start creating some issues here very soon. Job openings that used to be still are very near record levels, but if you look at the degree of the decline we've seen from those record highs are starting to come down significantly. And so the beginning of it all, it starts with the contraction of economic activity. And I think we're seeing most of that through leading indicators. You look at PMIs today, PMIs is a very, very good way, not only a leading indicator, but also a good measurement of what's happening in the economy. Today, it's at the lowest level since we've seen in the global financial crisis, in the COVID recession. We know that majority of the impact that we've seen so far with monetary tightening, which is not as severe as we've seen probably in the 70s, but when you're looking at the net change of things, which I think it's an important part of when you're analyzing macro indicators, is looking at the delta of those measurements. And I think that that's still going to be the case. We're still going to see that impact. The negative impact also has a lag of about 6 to 12 months. We've been into this for about 6 months or so already. So we should be starting to see some signs of deterioration in economic data caused by tightening, monetary tightening too. But most leading indicators from ISM manufacturing as well are also starting to plunge, and that's an important signal to me that on top of the economic activity is slowing down or actually contracting, you also have the tightening monetary conditions in general that I think it's going to be very bad. And so earnings are not reflecting that yet. They're very close. There's some companies starting to show some issues. I caution a lot of folks that are investing in companies that have been increasing their guidance for the next quarter. I think that's insane. And there's a bunch of companies doing that. That has been my focus of looking for those as a short opportunity. But, there's a list of those. And so, you're seeing FANG stocks. Remember, in FANG stocks are called growth stocks. Well, they're not growing anymore. They haven't been growing for a while. It's the first time they're growing actually in terms of real terms is actually contracting now. So there are a lot of issues there. So I think the economy is in a very tough place. It will be in a very tough place in about 6 months from now.
And do you think that the Fed can continue tightening for much longer, or do you think they're close to a pivot?
Well, we've seen sort of, I wouldn't say we call it a pivot, but calling it close to a neutral rate at sub 3% Fed funds rate when You look at the Taylor rule is telling you it should be at a 16%. So we're almost 14 percentage points away from what the Taylor rule suggests where interest rates should be. I mean, it's kind of insane that we heard that. We're always going to go back to the problems that we have. We face a trifecta of macro imbalances, and it's hard to believe any central bank or any policymaker would be able to navigate into this environment without those political constraints. Meaning, you have the debt problem of the 40s with the inflation of the 70s and the valuation problem of the 90s, late 90s, and so it's hard to believe you can really sustainably raise rates or let's say allow the dollar to appreciate too much. There's a lot of things that will have very bad ramifications in general to the global economy if we allow them to do those things over time. Interest rates is one of them. The dollar is the second one, and there are others. But and so to me, it's always been of my view that the Fed is trapped ultimately, and I don't know if they're going to change their course here now. I mean, I think if they do that, inflation is going to come roaring back. And my job as a manager is perhaps not to know exactly what's going to happen in the next meeting or so, but to have a plan ahead here when it comes to what might be the possibilities. The possibility is if they do anything like that right now, if they pivot in the next 2 to 3 meetings, it's hard to believe commodities are going to be trading at the current levels, which they have been had a correction, as you know very well. And I think that's transitory in my view. If we see a stronger stance towards inflation, it's hard to believe the economy is not going to have major issues, right? I mean, we're already it's the first time we're seeing yield curve inversions to the degree that we're seeing, and the Federal Reserve actually pressing on tightening monetary conditions. So it's hard to believe that that's also not going to lead to a severe decline in economic growth. And so it has been of my view that it all comes down to the commodities to equity ratio. I mean, I don't think there's any need to really complicate things, even though we all love to try to predict what's going to happen 3 to 6 months. But to me, the Fed is trapped idea really reflects into that ratio very well. I mean, it's the whole idea of owning tangible assets that you think will outperform financial assets that are near record valuations is still. I mean, most equity markets are still have valuations close to what we saw back in the peak of the tech bubble. And so it's hard to believe there's not more downside for equity markets. And so, to me, this is all whatever it's going to play into. I'm going to be readjusting into this ratio. I want to be long tangible assets. I want to be short financial assets over the next 5 to 10 years. And so, to me, that's the real goal. But it's hard to tell. I don't really have a strong view about what the Fed is going to do, but I have a view about what to do with my portfolio from those potential outcomes.
Yeah, so more of a long-term view, and I guess this correction we've had in not just commodities and precious metals, but also the stock market in the last few months is just a correction. And I would say the way you're looking at it, you'd need to buy the dips in tangible assets and sell the rally in stocks. I've seen there are some other macro analysts out there, and I won't name them. They're already saying that, well, inflation's finished, it's coming down, bonds are back again. You need to buy bonds. And almost like nothing's happened, and like everything's been solved, even though we have huge amounts of debt. The other thing, though, is with bonds, if the Fed were to pivot eventually and start more QE, they could theoretically keep interest rates very low, but you could still see commodities go up and gold go up, just like they've done in Japan. Or do you think the bond markets are a bit like the general stock market, where you try to sell rallies and not buy the dips anymore in bonds in terms of price? And maybe you could talk about what happened in 1973, 74, and whether we are maybe in that kind of period right now? And are we repeating that?
Oh, I think it's similar. I think you have to look back in history and look for inflationary recessions, and one that comes to mind certainly is 73, 74, because the economy was sort of not at the beginning. It was the second wave of inflation, but inflation was really entrenched in the economy, and I think we're in a similar position right now. To your point about bond markets, I mean, what worries me about bond markets is a lot of variables that I'm quite concerned about. One of them has to do with the geopolitical problems and this need for central banks to improve the quality of their international reserves. And I'm not sure treasuries are going to play that role, right? The treasuries are just debt from another indebted economy. And so it's hard to believe that's going to be used to improve the quality of their reserves and give more credibility to their fiat currencies. And so that's why I believe gold is ultimately the ultimate form of money that will prevail in this environment going forward too. 73, 74, or I should say that's the first variable on bonds. The second variable on bonds that I think it's very important has to do with issuance of treasuries that are happening here in the U.S. and to a degree that we haven't seen before. So we're seeing somewhere close. So initially, we saw a lot of issuances in a very short end, in the front end of the curve, meaning that the T-bills and so forth, they're all being issued at a very large pace. And then later on, we start seeing the notes being issued to a large pace as well. And now we're actually seeing one of the highest amounts of issuances in the very back end of the curve, meaning the 20 and 30 and some of the 10-year yields as well. And that's clear to me that most of the fiscal stimulus that we're seeing right now, which still is 4 to 5 times what we saw back in the 70s, adjust for inflation. I want to make that point again. Fiscal stimulus today, the levels that we have today of fiscal stimulus is about 4 times at least larger than what we saw back in the 70s. In the 70s, it was a very good general sense that fiscal stimulus was creating inflation. So they had to prevent that from happening. So they reduced the amount of government spending. Today, there's zero notion that that is actually leading to inflation. And so I don't believe in that. I think it's very strongly linked and correlated to what we're seeing as far as the diminishing of purchasing power by consumers in general is linked to a lot of the fiscal stimulus that we're seeing so far. And so fiscal stimulus, when you have an economy that is not making any money as far as trade balance goes, it's in a deficit as well. And so what about it is that you're not seeing more revenues than government spending. And so basically what we're seeing is they have to issue more treasuries. And so it's hard to be bullish on treasuries when you have a flood of issuance of those instruments happening today. And causing this yield curves, the yields on the long end to increase. It's actually fascinating to see that even though we're seeing this pressure for long yields to rise, we're still seeing yield curve inversions happen. So that goes to show how much of a strong signal, a recessionary signal, yield curve inversions are today. So about 40%, 42% of the yield curve is now inverted. Even when the market is rallying, yield spreads are actually inverting. So those are all important signals. Now let's go back to 73, 74. Stocks have to decline about 48%. I'm referring to the S&P 500, decline about 48% during that recession in order to cause CPI to start trending lower. And then we can have our discussions about CPI, but it's maybe a better measurement than it is today, back in those days. And one way we can gauge inflation at least. But that was the degree of the decline that we had to see in financial assets and the downward movement as far as demand goes and economic growth to cause inflation to pause and actually decline for 2 to 3 years and then come roaring back at the late 70s. And so to me, we haven't seen that, right? I mean, we've probably seen call it a 30+% decline in NASDAQ, 20-something% decline in the S&P at the lows. Now things have actually gone up significantly in what I think it's a bear market rally. to me, it's, I'm not in the camp that believes that we have seen enough destruction in financial markets to cause inflation to really decline. And so if the Fed starts pivoting as it has signaled recently, I think inflation will again show its teeth, and it will come back to an acceleration, even though it has been decelerating recently. So most of the, that's caused by supply issues and caused by the commodities market as well. And we haven't seen that the structural part of the thesis being resolved, meaning we haven't seen the capex trends being reversed to new highs or anything like that, like we saw back in 08, like we saw back in other times when inflation began to decline. We're actually on the other side of that capital investment cycle, so for natural resource companies. So sorry for the long answer, but that's the way I'm viewing all of this.
Yes, and when you said that inflation came down in 73, 74, you mean the rate of inflation, it was still a positive, right?
Yeah.
It like go negative.
That's
sure that people understand that.
That's a good point, Maneco. That's exactly right. So it went from double digits at the time, I believe, reached double digits to then low. I think the lowest it got maybe it was I don't want to say, but it was single digits. It was below 4%, I believe, and then it came roaring back to double digits one more time. And so the point being, we've seen an acceleration of CPI growth, and then we saw a deceleration that only started after markets were down about 48%. And so, it was a real demand destruction, right? We're not talking about 20% decline. And let's just keep in mind, valuations in 73, 74 were cheap compared to today, right? I mean, they're nowhere close to what we see companies trading at. If you read the books about the 70s and the 60s, and you remember folks complaining about paying 20 times earnings on companies in general. And I mean, this is nowhere close to what we're seeing today, right? I mean, it's a lot of companies trade at 20 times revenues nowadays. And so it's, to me, this is a much worse valuation problem than we had back in those days. And therefore why I think the reckoning is going to be a lot steeper than what we saw in 73, 74.
I guess another reason to lean towards, on a relative basis, towards tangibles. I want to change subject a little bit because I saw one of your posts on social media, and you said that you've recently said that there's 774 CEOs who have left their role this year in the US alone. What do you think that means? Because I think prior to COVID, like in early 2020, the same kind of thing was happening.
Yeah, it's way worse than it was back in that period you mentioned, and it's also way worse than prior to the global financial crisis. But it's quite interesting how CEOs tend to know something we don't know, and start to leave those companies. Then you can pick and choose and say, well, this guy's actually retiring, or this person is moving on to a new job. But when you see that such a large amount of those, I mean, usually that's linked to some sort of issue that is yet to come here. And we know that there's a lot of structural problems in companies in general. I mean, just look at the buybacks that we've seen so far. I mean, buybacks, which is financial engineering 101, right? I mean, it's companies that are not investing back in in their businesses and investing on buying back their shares at ridiculous prices. And so what's interesting about that is just if you look at the top 100 companies that are doing buybacks in general right now, about 89% of their cash flow was used to buy back shares. And that's about 4 times what we saw in terms of relative to their capex. And so they're basically buying back their companies, their shares at very high multiples. And you're starting to see not real growth, organic growth being driven by new innovation and other technologies by most of those companies. The so-called growth companies are not growing anymore, and so there's a lot of issues caused by the internals in the markets right now. And I also think that another problem we're going to see is related to the consumer consumption in general by households that will probably fall off a cliff. I'm very concerned about that because that's the next shoe to drop. We went from a lot of newspapers and articles talking about inflation to now we're going to be seeing more newspapers and articles talking about the fall of the consumption in general here in the U.S., which is being caused by historical high levels of prices that is squeezing consumers. You see mortgage rates increasing. You have consumer sentiment falling apart. And then you have saving rates not being as high as they were in 2021, which they were close to 30+% as a percentage of disposable income. They're now below about 5%. So you can see those changes. There's not a lot of cash in the sidelines as we saw back in 2021. That it's hard to believe we're not going to see a real a fall of consumption in the next call it 6 months or so, which is going to be a part of the issue with earnings as well, of corporate earnings in general. So yeah, I have a lot of views in markets as a whole, and I do think that's this is all linked to a bigger part of the problem.
I guess you could also argue that when buybacks were in vogue, interest rates were really low, so it was really cheap for these corporations to borrow the money to buy the shares, because a lot of people don't realize they don't have any cash to buy the shares. They go when interest rates are at zero, they go and borrow by issuing bonds to buy their shares. So maybe now they're seeing that rates are rising and they're leaving the ship. So it could be a signal that they expect things to get worse.
Well, to me, is if you're in a business for the long haul and interest rates are low, you should be borrowing money and your price of your shares are high. You shouldn't be buying back, your shares. You should be reinvesting in your business. You should be taking on a loan and doing something new. That I think that's the right approach for most corporate managers. And unfortunately, we did not see that. We're seeing basically massive packages of buybacks. And then in the middle of those packages, after they've been passed and they've been happening, the CEOs actually leave. And so we're seeing record amounts of CEOs leaving. So it's worrying. I mean, it's a little bit concerning to see all those shifts and companies not spending capital on. This is not just a commodities market. I mean, commodities market, we all know it's been a lack of investments in general, but we haven't seen that either in manufacturing, industrial companies, and so forth. Because they're buying back their own shares, and so I don't know what the reflection of all this is, but I don't think it's positive. And so I think this is very negative, and it's very much in line with I think our outlook is as far as what's likely to happen in the economy. You look at CEO confidence is actually plunging, and CEO confidence has usually leads employment, right? It usually leads what's going to happen with employment plans for most of those companies. But we have not seen yet, us going from a very tight labor market to a market that is missing a lot of those folks fulfilling those businesses as far as labor goes. It's important to remember in 2020 we had a recession, and then we saw all the stimulus coming in late 2020 and beginning of 2021 that drove one of the largest economic activities that we've seen in history in 2021 in nominal terms. Inflation was still low, was growing initially, but it wasn't as high as it is right now, right? And so it was at the beginning of an acceleration while central banks were calling it transitory, not looking over most of leading indicators. And that growth in the economy really exposed a supply problem that we've had for the long term in commodities in general. And so this is still a problem. It has not been resolved, but now we're starting to see demand fall off a cliff, and economic activity will unlikely be the same as it was in 2021. So this whole discussion of recession or not, to me is hard to believe we're not going to be in a recession. If we're not right now, it's hard to believe we're not going to be in one 6 months from now. So markets will react to that accordingly, in my view.
You were talking about the mining, the resource sector being there's low capex there. So at Crescat Capital, what are you looking right now in terms of commodities, natural resources? How do you evaluate the projects and the companies, and whether you trade those companies on a relative basis to other companies like in other spaces?
Yeah, well, I think it all starts from the view of if you think we are at the beginning of a bull market for commodities, the first step of most investors is to buy the physical commodity. As you dig deeper, you end up finding that there are some commodities that have higher volatility than others. Let's say if you want to be exposed to gold, perhaps silver may be a better alternative if you're bullish for the next 5 to 10 years. There's a bigger chance you're going to get a better return than buying gold itself. That doesn't mean gold is not a good investment. It depends on your profile for risk. Um, as you keep digging in, so, let's say in precious metals specifically, or base metals, and you start figuring out that the producers actually look quite interesting. Valuation wise, they're very cheap. They're making good amounts of money. They're paying very high dividends. Some of the gold miners today are paying higher dividends than utility businesses, which is insane to think. And so you can see the history of them. Most likely they would do very well in a pro commodities market that we think we're going to be in 5 to 10 years. And then you start looking at more risk. Let's say you like to take more risk, and you start looking at the developers. And the developers are interesting. There's a lot of good developing stories out there that are, I think, require a lot of financial knowledge and a lot of engineering knowledge to know what are the risks associated with which of those companies. But usually you're basically betting on a company that will figure out the consistency of their production, whatever mineral they're looking at, mostly metals here in this case that we're discussing. And so there's obviously some risks that are involved with those initial parts of the production cycle. And so most times you're looking for companies in that stage of where there has been a lot of de-risking. So they're mostly permitted. They're mostly got all their approvals that they need to proceed with those goals. But where I think is the most interesting part is really on exploration, which not a lot of smart capital is actually chasing those opportunities. And to me is amazing just because of the inefficiencies, the level of inefficiencies that we find in those markets. You can find companies that have discovery holes. What is a discovery holes? It's just a company that have posted let's say an intercept of over 100 grams per tons over meters. And if you got many of those over 100, you obviously have a discovery hole. And so usually the rule of thumb is 3 of those holes. And you can find companies today that have those 1 or 2 or 3 discovery holes already, and are not trading at levels that they should be trading in a bull market for gold. So meaning they should be trading well above 100 million in some of those cases, and they're still trading sub 20 million market cap. And so for a company that has a long-term view, you're capable of coming into that market with very good technical teams and management teams, and getting a stake of over close to 20% of those companies that you think probabilistically have a very big chance that we'll find very world-class mineral discoveries. And so to me, that's where the biggest opportunity lies ahead, especially from an asymmetry standpoint, but also from a macro standpoint, because I know that the major companies are facing a supply cliff right now. And so they will be chasing high quality exploration assets to replenish their production lines. And so at some point, we're going to see a lot of that capital going out of those producers to be chasing what they think are going to be new discoveries and new projects that are going to come online for being produced in the following years. But those are very long-term plays. I mean, they take, a very long time to reverse those trends. And so we haven't seen anything like that just yet, but it's quite, to me, it's very opportunistic to be able to, to take advantage of this market right now and really express your views, your macro views in that part of the industry at a time when no one is paying attention to that really interesting exploring phase of a mining company, which is where most of the capital has been made in this industry. And so for me is where the real opportunity is.
So I guess you're much more bullish on the gold and silver mining sector than, let's say, oil producers or natural gas or copper.
Yeah, good point. I didn't answer your question. So we are, we're bullish across all commodities, but there are commodities we're more bullish than others, and that usually is in line with not only the capex trends, but also what we know about supply, current supply, and future supply of those commodities. And so we know that the discoveries of gold and silver have been very, very low to actually close to none in the last decades or so. And so we know that that's a bigger problem, and so the constraints on the supply side are very compelling for an investor in that camp. Base metals, and I would put silver as a critical metal too, but critical meaning that will really fit into this green revolution thesis that will play out likely in the following years, like it or not like it. But silver will be a very important metal to be part of this new trend. And base metals are also going to be part of that. And it's important to find base metals that also have not only the potential demand side of the thesis, but also the potential issue of supply, of being rare and difficult to find, and difficult to find new discoveries in general for those metals. And I think copper is definitely one of them, and copper is down recently, and it's still a very tight market. So if you're able to find exploration assets in part of that metal, I think they're going to be good investments in general. I mean, keep in mind there's a lot of risk for the exploration to actually go wrong as well. So that's an important aspect of this. I think energy is also a very will be a very good investment over the next 3 to 5 years. We've been buying. We own about 20% of our portfolio in energy companies. We think we're in a situation where there's not only a political effort against energy companies, we're also seeing geologists and folks that work in oil companies leaving them to work in other industries and work in other places. And it's quite interesting to see those shifts at a time when oil is still about $100 a barrel. It's also amazing to see how energy prices have been holding up so well at a time when the government is selling over 30 million barrels of WTI every month, causing a real downward pressure in those commodities. Energy usually tends to have a little, a much shorter cycle than metals. So you have to have that time frame in your mind as you invest. And so we don't invest in very low liquidity or low market cap stocks. We invest in bigger market cap stocks in that camp because it's just the nature of what we think will play out in the following years. Now, I would say that agricultural commodities are quite interesting as well. If you look across the entire commodities market during the 70s, which was a good way, or also the 40s or even the 1910s, all commodities did very well, right? So, obviously agricultural commodities have a much shorter cycle. It's much quicker for you to see the reflection of a growth in CapEx into an increase in supply. It's much easier to see that. So we have to keep that in mind as we move along to the different stages of what we think it's a bull market for commodities. So it's a smaller allocation. Uranium, I think it's interesting from a demand side. I think there's definitely a political, potential political shift towards attracting the demand for uranium. The issue is, I don't think, I feel very confident that the supply part of the thesis is nowhere close to as compelling as it is to precious metals or base metals per se. There's enough uranium in the world, so it's not a supply story. It's a demand-driven story. If you're comfortable with that, that's the risk you're taking, right? So it's very different than gold and silver and copper and so forth. So it's a much smaller allocation, and with we trade in and out of those, even the gold and silver names, even though it's a much more static part of our portfolio when it comes to the precious metals and base metals exploration assets. They're very liquid, so we don't really trade as much as you would think. I mean, it's a very static part of the portfolio. If there is any trading, it's more buying than selling. I mean, there are cases where we change our view about a company because of management or because of the project itself, and we've sold some of our positions, but that's not usual. Usually, it's a more static part of the portfolio.
To change the subject a little bit, I don't know if you follow it very closely, the geopolitical part, and this has probably got to do a bit with your what you said earlier about uh, countries shifting away from holding treasuries as a reserve asset, and why you're so bullish on gold. Today, the day we're speaking today, we've been told that Nancy Pelosi is going to Taiwan tomorrow evening. Do you look at those things? Does it affect your decisions?
Look, I don't want to get political here, but to me, if I would get political, what Nancy Pelosi is doing is pretty clear to me. I mean, it's from a political perspective, it actually makes a lot of sense. I mean, she is, in terms of popularity, at probably all-time lows right now, right? I mean, she just got, basically everyone is talking about her trades with Nvidia and some other semiconductor companies that she's been buying before approving this package for semiconductor companies here in the US, providing somewhere close to $260 billion that would be unlocked into this industry. And she's been accumulating assets in that space before approving that. And who am I to judge if this is right or wrong? I do think it looks, probably not the right thing to be doing, obviously. I don't want to get into that, but it's probably very wrong what she did. Regardless, I wouldn't be surprised if she just sit down if she was just looking at her agenda and saying, look, how do we shift the conversation here and make this not be about that? We haven't seen any high level profile type of politician being in Taiwan since 1997. And I'm talking about high level to the level that she is, as far as of position in the government. And so, that certainly will call a lot of attention. But even though I am a believer that there's a big risk that China can take over Taiwan and so forth, I don't think that that's going to be much of a of a big deal. But what do I know? I mean, that's not going to change if something bad happens and causes markets to collapse. I mean, that's actually positive for my portfolio. Am I really seeing this as a potential trigger? Not really. I'm not counting on this. But I do think it's relevant. It certainly is relevant because we have a view about, especially if you go back to the 40s and start saying, well, in the 40s, inflation was actually transitory. And perhaps that's what we're going to see today. And the difference with the 40s and today is that in the 40s, we were at the end of a deglobalized world, right? We're literally at the very end of that stage. And in the mid 40s, when things actually it was the end of World War II, and we start entering a globalized, more, I guess, a trend of globalization that was at its early stages. And today, I think we're quite the opposite. We're at the beginning of a deglobalization trend, and so it's important. All those shifts that we're seeing with Russia and Ukraine, China and Taiwan, and China and US and Middle East as well. I mean, those are all very important, shifts in the geopolitical environment that I think are part of what we're probably going to be looking like, of a lot of developed economies having to go back onshore with their manufacturing plants and are going to have to rebuild their infrastructure in a very significant way in the following years. And that's going to be the second driver of demand for commodities, in my view. So in a way, this is all linked. But I do think Nancy Pelosi is just looking to to change the political focus from that. It might not work. Who knows? I mean, I'm not an expert of this, so I don't know. But it certainly seems to me like she's just trying to change the focus from what's been the focus recently, which has been all about the trading that her and her husband have been doing in the last months or so.
Great, Tavi. I don't want to keep you anymore because you're a busy man. Just wanted to ask you if you could tell the viewers where they can find you on social media. You have a big presence there, and Crescat Capital is very generous with their information. You're open about what you're doing, and I think the viewers would like to maybe get involved.
Well, I'm very appreciative of the opportunity of speaking here again in your channel. So thank you very much. You can find my work on Twitter at Tavi Costa. You can also find our work at crescat.net. It's our website, crescat.net. It's where you can find all information about our funds, but also about letters. If you're looking to just go a little deeper on our views, I would suggest you to read those letters, investor letters that we put out monthly, sometimes twice a month, on very detailed thesis that we believe will play out in the following years and how we're really expressing our views and so forth. I think a lot of people will enjoy that. So if you like that, just go there and check that out.
Thank you very much, and hopefully we'll talk soon.
Sounds great, Manek. Well, thanks for having me.
You're welcome.